Okay, everyone, we are going to go ahead and get started. First, I just want to say thank you. I want to say thank you so much to everyone who is joining this webinar that's all about investing in real estate. We have a bunch of people who have registered for this webinar who are either listening in live or who are going to listen to the recording. And in either case, we are just really grateful that you are connecting with us through this webinar. My name is Eric Thompson. I am your host as we go through this information today. So my role is I am president of Windermere Services here in Colorado. You should know that I've been in the real estate business now for 24 years. So I've helped lots of clients through those years, help them to acquire investment property. And I also own investment property myself. It's been a big part of my own personal strategy on building for retirement, building my own wealth is through investment real estate. So you need to know that. You need to know that as we embark that I'm a big believer in what I'm about to show you. And again, I'm just grateful that that all of you have joined. What I can promise you is a few things. You're going to get some really great takeaways today, things that you can implement immediately, and you're going to have a ton of clarity about what it really takes to own investment real estate. You're going to see all the numbers that go into this. There's no test at the end, which is really good news for you. I can promise you that. We're not going to email you a test. And I can also promise you that we're going to have a whole lot of fun as we go through this together. So hopefully that's all right with you that we have some fun. Let's do this as we start. For all of you listening in live, and a bunch of you are listening in live, if you would, do me a favor, would you type in, using the GoToWebinar platform, would you type in a comment to me saying that you can hear me? I just want to make sure that I am coming through loud and clear. I want to make sure you can hear me okay. And I see those comments are starting to roll in right now. So that's fantastic. It's always good to know that everyone can hear me all right and they're rolling in here fast and furious. This is also good practice for you because we'll have time at the end to take questions, and how you are notifying me that you can hear me is the exact way that you can ask me questions. So rest assured, we will take questions at the end. We'll make sure that we have some time for that. So all of you listening live will have that benefit to be able to ask questions. And of course, I love questions because everyone will get something out of your question. They may be wondering the same thing. So we encourage questions. Okay, so here we go. So this is all about how to get started investing in real estate. So what this is going to be very much about, this is about the basics. So maybe you've wondered about investing in real estate. Maybe you have friends or family that do it. You've heard about it. You've read about it. You see it on TV, and so you just wonder about it. And maybe it's what's kept you from doing it up until now is you just even don't know how to start. You don't know how the process looks. You don't know the steps. And what this webinar is going to do, it's going to clarify all of that for you. Okay, so this is very much about the basics. This is exactly how to get started in real estate. And I'll tell you right up front here, there's some things that, to be clear with you, there's some things that this is not. Okay, there's three things here that this is not. Number one, this has nothing to do with schemes. All right, so these things that we show you aren't going to cause money to start like raining out of the sky all of a sudden. You know, you're not just going to wake up and see your bank account, you know, has tripled overnight or anything. You know, so no schemes involved here. Hopefully that's all right with you. I'm guessing that it is. This also has nothing to do with like no money down kind of schemes or programs. This won't remind you of anything that you may have come across on late night TV or, you know, anything like that. You know, this is going to be some pretty straightforward stuff. Also, this is not anything to do with how to flip. Now, I think that for some people, flipping can be a really great strategy. It can work really well. Some people are, you know, just naturally inclined to be able to go out and find good homes to flip and do that work themselves even and flip homes. I do think that flipping can be a good strategy, but that's like a different webinar. We're not going to cover that today. So this has nothing to do with how to flip homes. All right. So I just want to be totally upfront about what this is and what this is not. So hopefully it's all right. We're not going to show any schemes or any no money down programs, and also we're not going to show you how to flip homes. What this is about, three things that this is very much about. This is very much about, as we go through this, it's very much about step by step. So I'm just going to show you the very simple step by step basics, how this works and how to get started. This also is very much about long term. So what we share here in this webinar, you'll see that we take a long term approach. We have a long term mindset to this. There's some real benefits to having that kind of a mindset and that approach. This is very much about long term. And also, this is very much about real life. So I'm going to share a personal real life story just so you can really get it. You can see a real life example about what happens when you invest in real estate and what the upsides can be, and really just how simple and straightforward this is. All right. So that's a little bit about what this is not, and also about what this is. Is that all right with you? Are you guys okay with that? I'm hoping that the answer is yes. Real quick, I'm guessing there's a lot of you on this webinar who have tuned in live or listening to the recording. You already know about Windermere Real Estate. If you don't, just real quick, a little bit about our company. This is where we're located. So we're located in these states that are all shaded in. That's where our company is located. We have about 6,000 agents all across those states. We have about 300 offices. We now have 7 offices in Colorado, all up and down the Front Range, here to serve you. And I'm guessing you already know about this because I'm guessing a Windermere agent has invited you, but that's just a quick reminder. All right. I encourage you to stay until the end so that we can show you how to get some valuable resources. For instance, our investment checklist is something that we'll offer you at the end, and I'll tell you exactly how to get that. Plus, there's a couple other things that we can offer to you as resources that we think will really help you out. So make sure you stay to the end so you can hear how to get those things, all right? One more thing, kind of housekeeping before we get too far into this, and this is to make our lawyers happy. As we talk about investing in real estate, just be sure as part of your process, not only are you consulting with us, you're also consulting with your accountant and your attorney. You know, they're a key part of this. You really need to do this. You need to do this with any real estate transaction, especially when it's investing in real estate. So this is our disclaimer. You want to be sure to consult with your accountant and your attorney. You know, we can't promise any kind of financial return on anything related to investing in real estate. We'll go through the benefits and be sure to consult with your accountant and your attorney. And now that our lawyers are happy, let's get into this. Okay, so here we go. I want to start this today, if it's all right with you. I'm going to start this with a story, and this is a personal story. I'm going to tell you the story about one of my own rental properties because I think it's very instructive. I think it's going to help you out to show you the power of investing in real estate and also how simple this can be. What you're looking at is a picture of one of the rental properties that I own. It's in Fort Collins. It's up in the north part of Fort Collins, and I'm going to walk you through what has happened because of me owning this home. So this is it's a little 3-bedroom, 1,100 square foot home. You can see it has a 2-car garage. Doesn't have a basement. It's in a great little neighborhood, good location. You know, it's not like right in downtown Fort Collins. It's kind of on the outskirts, but it's a great little neighborhood. So the address of this home is 1039 Berwick. And I say 2013 here on the screen because that's when I bought it. So in the summer of 2013, so about 5 years ago, is when I purchased this home. So purchased this home 5 years ago as an investment, and the purchase price back then, what I paid for that home was $180,000. All right, so I paid $180,000 for that home in 2013. Lucky for me, the price has gone up, and we'll talk more about that. But that was the value back in 2013. Purchased that home. Actually, I purchased it from another investor, someone else who had that as an investment home. And when I purchased this home, I purchased it with 35% down. Now, I could have gone as low as 25% down, and there are even ways to go to 20% down that we'll talk about more later. But I chose to put 35% down as my down payment for this home. So that equates to $63,000. So $63,000 was my down payment. And of course, I had a few thousand more in closing costs and those kind of things that when I initially acquired the home. But this was the bulk of my upfront investment was $63,000, which was my down payment. So again, I could have gone down to 25%, but I chose to do 35%. So that meant that my monthly payment, and my monthly payment includes here what I'm showing you, that includes my principal and interest on my mortgage. It also includes my property taxes and also my insurance. My monthly payment was $1,067 a month, and still is $1,067 a month. And I chose, at that time, to do a 15-year loan. Now, I could have chosen to do a 30-year loan, but I chose a 15-year loan. I chose 15-year loan because I just wanted to get that property paid down quicker. And I saw that because I was putting it's a a pretty sizable down payment down in that house. I was doing 35%, not 25, that I could keep that monthly payment kind of in line, keep it at a reasonable amount, even with a 15-year loan, and there'd be some benefits to the 15-year loan in that I could get the principal paid down quicker. All right. So then I had a renter in that property for $1,250 a month. So pretty straightforward, right? So again, 5 years ago, I bought this home for $180,000, chose to put 35% down. That was $63,000. So I got a loan, which meant my monthly payment was $1,067. And I was able to rent that property for a little bit more than my monthly payment, which meant that I had a little bit more to set aside for maintenance and for just the couple weeks that it sat vacant over those 5 years. I never had a problem getting renters in there. I had 3 different renters in there over the 5 years. Never had a problem getting a new renter in. Because I was renting it for a little bit more than the monthly payment, I was covered. I was always at least breaking even, if not cash flow positive. And this has worked really, really well. Now, this property today is about to go on the market. So it actually, as we speak, it's interesting. This is about to go on the market tomorrow. So that for all of you listening live, this property is going on the market tomorrow, and I'm listing it because I want to trade it up to a larger property. Okay, so I just want to get a larger investment home, and that's why I'm going to list it. And I'm also listing it because it's done pretty well. As an investment, it's appreciated really well. So it's going to go on the market at $280,000 based on the comparable sales, based on what's happening in the market, all the analysis. It will sell for $280,000. I know that. So $280,000 is the sales price. That'll go on the market tomorrow. A question came in: did I have a property manager? I did. I chose to have a property manager, and we'll talk more about property managers here in a little bit. Just for my kind of my MO and my style, I chose to have a property manager, but I didn't need to have one. So $280,000 is the sales price. Today, my loan balance sits at $92,000. So as you see this, what you're realizing is that I'm blessed in this home with quite a bit of equity in this home, right? So I have $188,000 of equity sitting there in this home. So what happened over 5 years is my $63,000 became $188,000. And again, we're not talking schemes here. Money is not raining from the sky, but because 2 things were happening over those 5 years, I was able to create this equity in this little 1,100 square foot home. The 2 things that were happening is, number one, I had a renter in that home who was paying my mortgage down for me. So they were paying me rent, and I was sending that rent basically right over to my mortgage company. And every month, my loan balance was going down, and my renter was doing that for me. So that was building equity. And then on top of that, the market was going up, right? The market was appreciating. Lucky for me, and we'll go through the kind of history of market appreciation here in the Front Range of Colorado. So today I sit with $188,000 of equity, and yes, there'll be some sales costs that I'll have when I sell the property, but this is just simple, straightforward on what happened with this home. So this is an example of the power of investing in real estate. This little house doesn't even have a basement, 3-bedroom, 2-bath house. Paid $180,000 for it, and look what's happened today. And I'm going to take this equity, go reinvest it into another rental property because I believe in this so much. All right. So here's the deal: real estate is a few things. Okay, real estate is, number one, it's straightforward. It's a house, and there aren't many things more straightforward than a house. We live in houses. We grew up in houses. People understand houses. And for the most part, people are getting a mortgage when they buy a house. You can pay cash, of course, but most people are getting a mortgage. Mortgages are pretty straightforward. Yes, there's a qualification process you go through, but real estate is very straightforward. Real estate is also tangible. What I appreciate about real estate is that I can go drive by the rental properties that I own. I can drive by and check on them. I can go inside of them if I want to. I can meet my renters. I can shake their hand if I want to. So real estate, another thing I like is real estate is a very tangible thing. And the other thing I like is that real estate is desirable. It really comes down to the fact that people need a house to live in. It's one of the 3 basic needs that people have. People need food, clothing, and shelter, right? And so we're providing one of those needs by our investment real estate. We're giving someone a place to live. And the other great news for us as we think about investing in Colorado and specifically the Front Range is a very desirable place to live. There are a whole bunch of people who are moving here. We all know that because we spend time on I-25 and we see the traffic and we read the stories about all the people who are moving here, and we read the stories about the shortages of housing. So housing is desirable. That's what I love about real estate, as opposed to how about opposed to Bitcoin, right? So I'll respect anyone that's investing in Bitcoin, but I tell you what, Bitcoin is not straightforward at all. I cannot understand Bitcoin. I've read about it. I try to understand it. I don't know about you, but I do not understand Bitcoin. Bitcoin is not tangible. Bitcoin is a bunch of numbers on a screen. And in terms of desirability, I guess it's desirable for a certain segment of the population. I read that people into Bitcoin, they tend to be like drug dealers and pirates and people like that. And, that real estate doesn't really attract people like that. Again, I'll respect anyone that's investing in Bitcoin, but, investing in real estate is a whole lot different than investing in Bitcoin. And also, real estate is different as opposed to the stock market. And believe me, I believe in diversity. I have money in the stock market, and the stock market can be really confusing. The stock market is not necessarily straightforward. It can be super confusing. It's not tangible. That's a frustration I have about the stock market. And it takes these wild swings. Remember that day? It was about 6 weeks ago. The stock market crashed like 10% in one day. And I appreciated that my real estate didn't go down by 10% in one day. So what I encourage is diversity, right? So yes, have money in the stock market and have some money in real estate too, because there's some really different benefits that real estate can provide as opposed to the stock market. All right. So that was just for fun to talk about Bitcoin and the stock market. Now let's look at the real estate market. Okay. Let's look at the real estate market, and I'm going to show you this really interesting and really valuable chart that we refer to quite a bit. I'm going to blow it up on the screen so it's nice and big. And let's go through this, all right? So what you're looking at is the Metro Denver market. And I will tell you that for the bunch of you who are listening from both Larimer County and Weld County, know two things. Know that the pattern is pretty much the same in those other areas of the Front Range, and also know that we can get you this chart for Larimer or Weld County if you're curious to see it. We just don't have time to show all the different markets on the Front Range, but just know that the pattern is very much the same. And what you're looking at for the Metro Denver market is a history going all the way back here to 1977 of year by year price appreciation in the real estate market. So let's just pick a year. Let's say, for example, 1997. Right here, the real estate market went up that year 6.41%. So prices went up 6.41%. And then the next year, they went up another 6.68%. And then the next year, they went up 12.93%. So each blue bar represents that particular year's price appreciation. So what you'd look at first, what you probably will notice as you glance at this is good news for us. There's a lot more bars going up than going down. Here was a down year, 1987. Prices went down 4.36%. So more up years than down years. That's a good thing. The other thing that you may notice is we had this stretch right here when the real estate bubble burst where prices went down. But what's interesting is then, really the worst economy of our lifetime, prices along the Front Range were going down just over 2%. So 2008 was a terrible year for real estate across the country, and yet prices on the Front Range are only going down about 2%, followed by a year of down 1%. Compare that to a place like Miami, which was down well over 20%, or Las Vegas or Phoenix, well over 20%. So our markets tend to stay pretty well insulated from swings like that. You should know that the long-term average, so over these 40 years, this is now 40 years of data, the average for the Front Range for the Denver metro market is 5.63%. So that's the 40-year average. You can see recently in the last few years, we've been going above that average. But what's really interesting, if you were to look at this 10-year snapshot, this 10 years is right along the lines of that 40-year average. So really what's happening in these recent years is we're compensating for these down years to get the market back to what it's always done over time, which is appreciated about 5.5%. So again, the long-term average is 5.63%. So the purpose of showing you this graph is just to show you over the long term, the front range market really performs. Certainly there are down years, but there are more up years than down. And what we know over the long term, and this is based on 40 years of data, the market goes up by about 5.5% per year. We don't expect that these prices can continue this pace. We expect the pace of appreciation to eventually slow down. We don't imagine double-digit price appreciation to keep occurring year after year after year. We expect this to get back closer to the long-term average of being about 5.5%. For the market to turn and prices to go down would take something really catastrophic, some big external change in the market or the world politics or something. And, again, look what happened in the worst economy of our lifetime. Prices went down just over 2%. So we want to show you this is to just give you an idea of how the market has performed over the long term. Again, what you need to know, it's about 5.5% per year. So as you build out your models, as we plug in numbers to imagine what prices may do over the long term, that's a good reference point for us, is that the fact that along the front range, prices have gone up about 5.5% per year. Okay. Now, how about vacancy rates? Vacancy rates are always a question. People wonder about vacancy rates, of course, when they think about investing in real estate. What I did in preparation for this webinar, I just went to the state of Colorado's Division of Housing website, and I just took a screenshot. So this image right here is just a screenshot right from that website. So again, the state of Colorado Division of Housing, you can see it right here. So you can see what's happening for vacancy rates all across Colorado. So most of these cities, of course, are along the Front Range. They also decided to include Grand Junction. So these are the larger cities in Colorado. And what you need to know is that any number that's near 5% is very, very healthy. Some people say, who are savvy about investing in real estate, that 5% vacancy rate is essentially 0% vacancy rate. 5% vacancy is essentially no vacancy. So any number that's near 5% shows a very healthy market. Certainly anything under 10% is good. So what we notice here is that the Denver metro area is at 6.4%, the Springs at 5.4%, Northern Colorado, both at Fort Collins, Loveland, and Greeley, even lower than that, 3% here in Larimer County, and then 2.2% in Weld County. Pretty significantly low numbers. So this is good news for you as you think about potentially investing in real estate. You're going to wonder, well, what are my chances that the property sits vacant? Given, again, that the Front Range is such a desirable place to live, that so many people are moving here, that's what causes these vacancy rates to be so low. So now let me take you through a really simple 4-part formula. Okay, so I want you to write this down. You're going to find this to be super straightforward when it comes to investing in real estate. There's a very simple 4-part formula to this. All right, step 1, the first part of this formula is you want to acquire a property with 25% down. In a moment, we'll talk a little bit more about down payments, and I will tell you that you can find programs out there where you can purchase with 20%, but really you should plan on at least 25% as your down payment. So part 1 of this formula is you want to acquire a property with 25% down at least. You could certainly do more. Then the second part of the formula, you put a renter in the property. Okay, there's some different ways to do that. And the different ways to do that is that you can do it yourself, or you can hire a property manager. In a little bit, I'll show you more about the expense of hiring a property manager and what you can expect to pay them if you choose to go that route. But this would be part 2 of the formula. You put a renter in the property. Then part 3, you know what? Let your renter pay your mortgage down. So they are paying your rent every month. And in the case where you do have a mortgage on the property, and in most cases we find that, you can certainly purchase with cash, and that's a really nice thing. But if you have a mortgage, what's happening is you're letting your renter make your mortgage payment. Your renter is paying that mortgage down for you. And so your principal balance is going down every single month, which means that property is performing even without appreciation. So part 4 of the formula is to let the appreciation be the icing on the cake. So you need to know, as we consult with you, as we talk to you about investing in real estate, what we know and the way we think about this and our approach that we have is that the appreciation is the icing on the cake. The cake itself is that renter is in the property and they're paying that mortgage down for you. If you do it right, they're also paying your expenses and even creating a little bit of a cash flow for you. But the cake is the fact that they're paying that mortgage down, and it's causing that equity to build month after month after month. Your equity is building because your renter is helping you make that happen. Okay, the renter is doing that for you, and any appreciation is icing on the cake. And so this is the mindset I had when I purchased my property that I showed you about, is that the cake for me would be the fact that they're making those mortgage payments and they're paying my mortgage balance down every month. And if the property appreciated, if the market went up over time, and I was confident that it would go up at least 5% per year, that for me was going to be the icing on the cake. All right. So that is the 4-part formula. There are 2 major money aspects to this. All right. So as you think about the money involved, there are 2 major money aspects, pretty straightforward. Number 1 is the down payment itself, and number 2 is the monthly payment. So, as you think about the money that it takes to do this, these are the 2 things to focus on: the down payment and the monthly payment. So let's just take these one by one. Let's first look at the down payment. So for most mortgage programs out there, you're going to be looking at between 20% to 35% down. As I mentioned before, in most cases, it's 25%. There are some programs out there that allow for as low as 20%. And in some cases, you do need to go up to as high as 35%. It's really going to depend on the loan program that you pick and also on your credit score. So the better your credit score, in many cases, the lower the down payment that you need to have. The higher the lower the credit score, the worse your credit, the more the down payment you need to have, right? Makes sense? Pretty straightforward, but the amount of money, the percentage that you should plan on as you think about compiling the down payment to make this happen, the number you should plan on is 25%. So that's just a good rule of thumb. That's the number to focus on. That's the number to think about. So just for example, if you were thinking about a $300,000 rental property, 25% down would be $75,000. Okay, so $75,000 would be your down payment. Then you want to plan for another 2% on top of that for your closing costs. So then, of course, you're going to think about, well, where would that money come from? What's really great about real estate is that there are actually ways to invest in real estate inside of your IRA. So you may have an IRA or a 401k or some kind of retirement plan. There are actually ways out there, ways for you to, instead of that money being in a mutual fund, for example, or inside of stocks, you can have that money in real estate. If you want to know more about that, you want to reach out to your Windermere broker. That's how I own some of my investment real estate, is inside of an IRA. So that's one way. Other ways maybe you may just have that money in savings, or you may be able to save up some money. Maybe you're getting a bonus from work. Maybe you're getting some money from a relative, and in some ways, maybe in a sad case, maybe it was an inheritance. Maybe you've had some inheritance monies. Maybe your relative passed away, and you've come across some cash and some money, and so that would be another source, of course, way for you to do this. So 25% is the amount of money that you want to kind of target as you start to budget for your down payment. Now, the second aspect is your monthly payment, right? So we have the down payment, and now you have your monthly payment. So your monthly payment is, of course, dependent upon your interest rate. And the interest rate, just like the down payment, the interest rate that you can get from a bank, from your lender, it's really going to depend on both the loan type that you get and also your credit score. So if you have great credit, you have the opportunity to get an even lower interest rate. If not so great credit, you're going to look at it at a higher interest rate, right? Pretty straightforward stuff, okay? The other thing you should know is that investor rates tend to be higher than for your primary home. So usually by about 0.5%. It can kind of vary lender by lender, but you need to know as you're looking at rates for your primary home, and rates that are published out there, rates that are being advertised and marketed. Those are rates if someone is buying their primary home. investors are going to pay a little bit higher rate, usually about a 0.5%. Okay. Now, the other thing too about today's environment is today's environment offers incredibly low interest rates, and that's why investing in real estate is so attractive right now because of how low rates are compared to their long-term average. Even though rates we've watched go up here recently, and they're predicted to go up even higher, today's rate environment is incredibly attractive for the investor because rates today are running near half of their long-term average. So if you look at their 40-year average of the mortgage interest rate today, they're roughly half of that long-term average. So rates today are super low. So just for example, if you had a $300,000 property, you put 25% down, that would mean a $225,000 loan. Let's say you were able to get an interest rate at 4.5%. If this was amortized over 30 years, your principal and interest payment would be $1,140. Okay, so then of course you would add the other expenses on top of that we'll talk about here in just a moment. You would add your other expenses on top of that, and then you evaluate that versus the rent that you believe that you would be able to get for that property. Okay, so that's just an example. $225,000 loan. Your monthly payment you're looking at for principal and interest would be $1,140. Okay, now let's give you some numbers to use in your budgeting. All right, as you build out the model, as you start to sketch this out and see exactly what this looks like on a month-by-month basis, I'm going to give you two numbers that are really good to know. The first one is property managers. So when I say management here on the screen, what I mean is property managers. And if you're thinking about a property manager, what you should budget is 10%. Sometimes you'll find management fees a little bit higher, sometimes a little bit lower, but just plan on 10%. So 10% of the monthly rent would be paid to the property manager. So what are they going to do for that 10%? Well, they're going to screen potential renters. They'll do things like run their credit scores. They'll even check references. They'll handle all the marketing of the property. They'll field all the inquiries on the property. They'll show the property to potential renters. They have all the documents, the leases, the credit check documents. So they will help to select the renter. They'll put the renter in the property. They'll collect the security deposit. And then, of course, they'll collect the rent every month, and they'll ensure that the rent is coming in. If there's ever a problem with the rent, if the renter isn't able to make the rent payment, and of course, they're going to be the ones doing the follow-up with them and assessing the penalties in that case. So they do all those things for 10%. They facilitate the move out of one renter and the transition to the new renter. They evaluate the property at the end of the lease to see if any money from the security deposit needs to be retained. All of those things they do for you. And I found for me personally, I like having a property manager. I just don't have the time really to do all those things for my rental properties. Now, there are plenty of people that I know who like doing all that themselves, and they would rather not pay that 10%. They have the time and skill set and expertise to handle all that themselves. They'd rather not hire a third party. They'd rather work with that tenant directly. They'd rather not pay the 10%. So that also works. So what we recommend, our advice to you is just pick whatever method works best for you. We know some people who start off managing the property on their own, and then they decide later on, you know what, this is maybe a little bit more work than what I thought, and it's going to be worth it to me to hire the property manager for 10%. But that's the number that you want to budget is 10% for management. The other number that you want to budget is maintenance. So we think a good number is 8%. So as you think about things that that you may have to do to the property for upkeep, maybe it's new carpet when one renter moves out, maybe there's some touch-up painting, maybe something with the landscaping, whatever it is, you want to budget 8%. In your formula, you want to budget 8% for maintenance, right? So those are two of the big numbers that you want to be aware of as you do your budgeting. So again, 10% for management fee, 10% of the monthly rent, 8% is for maintenance, all right? Now, the good news for you is that we can do all this for you. So we have analysis tools, we have spreadsheets that we've built to help our investor clients do all this analysis. So if your head's starting to spin a little bit and say, geez, this is going to take a lot to sit down and do all this analysis, do this evaluation. The good news for you is that we can do this for you. We have a spreadsheet built where we can do this, or we just plug in the numbers, and the spreadsheet will show us what's going to be happening on a month-by-month basis. So what we want you to do is reach out to your Windermere broker when you are far enough along in the process, and we'll talk more about that. Reach out to your Windermere broker, and they can sit down with you using this spreadsheet. They'll go through it with you. They'll plug in the numbers for you and show you the results and show you how that property is going to perform. All right. So here are the steps. Okay. So these are the 5 steps. These are really, when you boil it down, this is what it takes to get started. These are the 5 things that you want to do, and you want to do them in this order. And you do these 5 things, and you're going to be on your way. All right. And by the way, you're going to find this to be super simple, really straightforward, nothing really earth-shattering here. Step number 1 is you want to clarify the outcome. This is so important to do first. It's so important to have clarity on what it is that you really want to accomplish with this property. And it's different for every person. So it may be that you want to have this property to help fund your retirement, and you may have a certain date in mind that you're going to retire. You may say, you know what, I'm going to retire in 15 years, or I'm going to retire in 10 years, and I want this property to really help me out, to be part of my income when I'm retiring, and so that's my outcome. It could be you want to fund your child's education. We find that a terrific way to fund college is to buy a rental property. Could you imagine buying a rental property for your 3-year-old, and in 15 years, when that 3-year-old is now 18 years old and they're ready to go off to college, can you imagine what's now sitting there inside that property, all the equity in that property that can help fund that child's education? And you know what? Even if that child is 13, not 3, this can still be a terrific vehicle to help fund a child's education. We have many clients who have set a simple goal that they want to have one rental property for each of their children to help fund their college, and maybe someday they'll pass it on to their child, but they want to be sure they're funding college. And what a terrific way, and really straightforward, easy way to do that is to buy one rental property for each child. So again, we need to be clear on the outcome. What is it that you want to accomplish by owning this property? Maybe it's just you want to diversify. Maybe you feel like, gosh, I have so much money in the stock market. I just want to diversify. I want to have some of that money now in real estate. That's my outcome. So we're going to clarify the outcome first. And then the second thing that we're going to have you do is we're going to have you get pre-qualified. You may have a relationship with the lender already. If you don't, there's some really terrific lenders that we can connect you with. We'll get you connected with a great lender who understands rental properties, that can show you different programs to help you out. They'll help you look at, for instance, a 15-year versus a 30-year and all the different programs that are out there. We want to get you pre-qualified first. This must happen way up front in the process, certainly before we're out looking at properties, certainly before we're out trying to make offers on properties. We want to have that pre-qualification, and even better, a pre-approval in our hand and done, so we know exactly what you qualify for, and that puts us in a much better qualifying and negotiating position with a potential seller. All right. So then once you've done that, we're going to help you run the numbers. Now that we know kind of the price range you're going to be looking at, we'll help you run the numbers. We'll put that price range through our model that we've built. We will help you look at projected rents for that property so we can know what the monthly revenue is going to look like, and we're going to help you with the evaluation. We're going to see, how does this perform month by month? Is this causing cash flow? Is it cash flow negative? Well, you know what? That's not a good property. Let's go find another one. Let's go find one that works. But we're going to run all these properties through our model to ensure that it makes sense for you and ensure that it's going to help you meet your goals. Okay. So once we know what you can qualify for, we run the numbers so you can have a good idea of the properties that we now want to go identify. So once we have a general sense of what the numbers look like, then we go hone in on specific properties, and then we go acquire. And the way we do that, of course, is by making an offer. And we'll go through those steps with you. Even before we get to step 4 in this process, we'll show you all the documents that are required to go make an offer. It's really straightforward. we already have our pre-approval in hand, puts us in a better negotiating position when we go out to acquire property. So once we know the numbers, we go out, we identify the property, then we acquire it, and we feel really confident that that property is going to perform because we've already run the numbers on it. So once we've identified it, we've acquired it, we've now closed on that property. What's next? Pretty simple. Now we put a renter in it, right? And you're either doing that yourself, either through your own marketing and advertising and your own processes, and we can help you with that. We can give you some good resources on where to go to be able to get some of these documents if you choose to go on your own. But you may be someone like me that chooses to hire a property manager. They'll help you put a renter in the property. Now your renter's in that property, and now they're helping you pay that mortgage down, right? So it's really that simple. I told you that this is going to be pretty straightforward, nothing earth-shattering here. These are the 5 really essential steps. So what's next for you after this? After going through this and seeing how straightforward it is, well, what's next for you is to connect with your broker, right? So you want to reach out to your Windermere broker who invited you onto this webinar, and you want to ask them for the investment checklist. So this is a really great way to start. We'll get that in your hands. It shows you everything that you need to think about to get started investing in real estate. I'm guessing that this webinar alone is giving you the simple steps, and investment checklist has a few more things on there, even more detail, shows you in writing exactly what needs to happen for you to get started. So that's a really nice resource for you. We also have a little white paper that we wrote that's about investing in real estate. So that's something else that our Windermere broker can get in your hand. And then after that, we'll help you get connected to a lender. So as we mentioned on the last slide, that's a really important step in the process. We want to do that very early on. And even if you're not 100% sure that this is something that you want to do, this is a great way to get started, just so you understand what it looks like on a monthly payment basis, and also what interest rates look like, what the different programs are. We can connect you to a lender so that you have a whole lot of clarity about all those components, all right? So we'll get the investment checklist in your hands. We'll connect you with the lender, and then if you want to take the next step, what we'll do is we'll run the numbers for you. We can even start by running some hypothetical numbers. Let's pretend it's a $325,000 property, and this is what we think the monthly expenses are going to be based on the model that we have, and then this is what we think it's going to rent for. What does that look like? Does that look like this is going to perform the way we want it to? Does it look like it's going to help us meet our goals? All right. So that's really it. That's really the simple next steps. You want to connect with your Windermere broker. They'll get the investment checklist in your hands. They will connect you with the lender if you want to see more about how this works, and then they'll be there to help you run the numbers. So we are at about 45 minutes after the hour, and so now we have now plenty of time to answer any questions that you have. And I knew that the question component would be a really valuable time here, and I know lots of people are going to go to benefit from the questions and hearing the questions. So go ahead and type in a question to me. If there's something on your mind, something that I can help you with, maybe something that wasn't covered, maybe something that you want a little more clarity on, maybe something I did bring up, but something you want to get more clarity on, I'm more than happy to help with all that. And what I have here on my screen is a little dashboard that will show me the question that you can type into me. So if you have a question, just go ahead and type it in. I'll be able to help you out. So, great question. So here's a question that came in. Is the analysis the same for commercial real estate investing? Yeah, absolutely. It's all the same principles. It's simply looking at revenue and expense, then leads you to net income on a monthly basis. So we can absolutely plug in commercial numbers, based on a certain purchase price and a certain amount down, and we could do things like evaluate cap rates for you. So yeah, terrific question. Absolutely, it's the same with commercial real estate. Let's see. Here's a question. Where's a good place to look for rental rates for a neighborhood? Well, kind of depending on where you are along the Front Range, There are a lot of websites out there where renters list their property for rent. So, for example, in Northern Colorado, I believe it's nocorentals.com. That's a good place to do some evaluation for rentals. But it kind of depends on where you are in along the Front Range, and I think it's something that's pretty easily searchable online. Something we can pretty easily find that. So. All right. So, yeah, a comment came in that they always start by looking at Craigslist. Yeah, absolutely. The question came in, does the model consider tax implications? Yes, it certainly does. There are tax benefits to owning real estate. Absolutely, there are. Chose not to get specifically into that today, just to keep this, on a really basic level. And what I know is that the real estate will perform even without considering those tax implications, but the tax benefits make it perform even better. So the model that we have, yes, it does take taxes into consideration. Let's see. Those are the questions so far. I'll just give it another moment to see if there's any other questions that are coming in. One thing that comes up too, just thinking about how I talked about the stock market. Stock market versus real estate is, number one, I believe in diversity, right? We never want to have all of our eggs in one basket. Personally, I sleep well at night knowing that I have some money in the stock market and I have some money in real estate. I like having money in both. And one of the beauties of real estate that, I guess I alluded to when I talked about my own personal example, but to be a little more specific about it, one of the beauties of real estate is leverage, right? So you think about that little 1,100 square foot home that cost $180,000, but I was able to acquire it for $63,000 was my down payment. So, even though prices are going up, on average, I mentioned a little over 5% per year, prices are doing that. But if you were to do the ROI on my $63,000 over that time was over 20% per year on my down payment. So that's another beauty of real estate is leverage. The fact that you can acquire these properties for 25% down in most cases, maybe even if it's 30, you can realize a much better ROI on that down payment than simply what the stock market may be doing. Let's see. Great question that came in. So, how do you invest in a market that's so competitive? Well, you know what? The reality is the market absolutely is competitive. It's competitive because it's in such high demand. The Front Range is very popular. Lots of people are moving here for various reasons. Most importantly, we have a very healthy economy. We have low unemployment here. Companies are growing. We have a diverse economy. We're not reliant upon just one industry. Tech are wonderful quality of life on top of that, and that means a whole bunch of people are moving here. That means that the housing market is competitive. So the way that you compete is, it's just like on a primary residence. Number one is we got to be prepared, right? So we have to be prepared with a pre-approval that will make our offer stand out. We also need to really know our numbers. So in a competitive environment, sometimes you need to bid at asking price and sometimes even higher than list price in order to be the winning offer. And before we're doing things like that, we need to really know our numbers. So we need to know what price makes sense and what price does not make sense. We need to understand our ceiling going into that environment so that we don't overpay, so that it hurts us on a monthly basis. So then our investment is not performing because we paid too much for it based on what we believe the rents are going to be. So we just really got to be prepared. We got to understand our numbers up front. Great question. Should someone start small with a condo or duplex versus diving into a single family home? All right, here's what I think. I think that someone can easily start with a condominium or single family home. There's some advantages to either one. What I recommend is that you invest in one of those two things before you start investing into things like land or big apartment buildings. Once you start doing things like that, then that becomes much more risky. But in terms of risk, I really view a condominium and a single-family home as the same. Some people like the thought of investing in a condominium because you have the HOA that's going to be taking care of a lot of the maintenance for you. They're taking the lead on things like the roof and the painting of the exterior, the landscaping around the property. So they like the thought of a condominium because they see that it's going to be a little less maintenance, a little less time intensive because the management company for the HOA is handling those things. But in terms of risk, I really see them being the same, a condominium or a single family home. But that was a terrific question. Great question. Let's see here if any other questions roll in. And thank you for the questions, by the way. I know that everyone gets a benefit when the questions are asked. Let's see. Right now, I'm not seeing any questions. So if you have more questions, you are welcome to reach out to me. I'm going to show you my email address here. There's my email address. You're welcome to reach out to me, or more importantly, reach out to your Windermere broker. So for most of you listening, you had a Windermere broker that invited you on here. They're really savvy when it comes to investing in real estate. They can help you out. They have these resources that I mentioned to you, and they can help you. So what I want to do now is just say thanks. I want to say thank you so much for your engagement. That was really terrific. Again, a bunch of people registered for this. And I know a lot of you are going to be listening to the recording as well. You should know that even if you are listening live, you will receive an email with a recording of the session. You should get that within an hour of us wrapping up here. So again, my name is Eric Thompson. So appreciative of your engagement through this. Happy to help you with any questions that you have. And I want you to enjoy the rest of your day. Take care. Bye.